Hello, I'm Rachel Rickard Straus, editor of Moneywise, and I'm here with Job Curtis, who's manager of City of London Investment Trust, and he's going to tell us about it. Job, thanks so much for joining us.
Pleasure.
Tell us a little bit about the trust, what it is, what it does.
Well, the trust's objective is to grow shareholders and investors' money in the long run, both in income and capital growth. We're predominantly invested in large capitalisation shares, so the big FTSE 100 companies. We're focused on the UK, we're 90% in FTSE 100 and FTSE 250 stocks. But most of our companies are listed in London, are fairly international. We have some with domestic exposure, and we have 10% in overseas blue chip stocks. So overall, we're quite a conservative blue chip portfolio.
So big UK listed companies.
Yes.
And why should people invest in it?
Well, I think there are three main reasons. We've got an exceptionally good income record. We've grown our dividend every year since 1966, and we've achieved this through the investment trust structure. Yes, we have a core of quality companies that have been able to consistently grow their own dividends, but in addition, we have a situation whereby we can hold back a little bit of income in the good years, up to 15%. Typically, we might hold back around 5%. We put that into revenue reserve, and then in the bad years for dividends across the market, we're able to use that revenue reserve. So in the 28 years that I've been manager, 7 years we've needed the revenue reserve to keep growing our dividends. The investment trust structure has been extremely important. The second reason to invest in us is we've got very competitive charges. Our ongoing charge ratio in our last financial year was 0.39%, which is the lowest in our sector and one of the lowest across the investment trust sector. And the third reason is we've delivered good outperformance in the long term over the FTSE All Share. We can't outperform every year, but in the long run we've achieved outperformance.
So it's cheap. You get for over how many years? 60?
It's 53 years.
53 years. You've had an income year in, year out.
Yes.
What was the third again?
The third is long-term outperformance in terms of total
outperformance.
return. Yes.
So how have you kept the charges so low?
Well, we have an independent board of directors, and that's a feature of an investment trust, and they negotiate the fee rate with Janice Henderson, who I work for, and I'm the appointed manager of City of London. So, but the fund has grown a lot over the last 9 years. It's increased its shares in issue by over 80%. So it's now a £1.6 billion fund. So it's a very good client for Janice Henderson. So we kind of work with the board, and it's certainly its blue chip nature and competitive charges are good features for investors.
Okay, and tell us about your role. What gets you out of bed in the morning? And then when you're up, what does your day look like?
Well, you know, my wife and 3 children are first and foremost what get me out of bed. But I do, I find the stock market endlessly interesting, and every day I come into the office and new things have happened, and I've followed the fortunes of the companies for many years, and I'm fascinated by their ups and downs and how their share prices are doing. So certainly when I come into the office, I switch on, I have a Bloomberg terminal and catch up with the news, and we get a lot of company announcements, tend to be at 7 in the morning, and catch up with what's gone on and what's gone on overnight in the foreign markets.
How do you deal with all of that? I want to call it, sometimes it feels like noise. There's so much going on. It's such a tumultuous time. There's so much uncertainty. Yes. To what extent do you factor that in to your decision making, or do you sort of have to have a strategy, clear head and go for it?
I think you have to have an overall approach, and a long time ago a well-known writer called Benjamin Graham on the stock market said the stock market's like a manic depressive, and it's either sort of euphorically happy about things, or it gets very depressed and far too depressed. And this is, you know, there's a lot of emotion in the stock market, and for my type of investing, you have to stand back from that and have some principles. And I'm looking to buy good quality companies at attractive valuations, and I'm also looking for companies that can consistently grow their own dividends over time, and they proved, in my view, to be good investments. So you have to have a kind of underlying philosophy, but I think you also have to have an open mind. You can't, you know, you have to be prepared to change. I mean, there's a lot of disruption, for example, going on in the economy, and you know, new technologies can wipe away industries. So you have to be very aware of the new trends out there. But at the same time, I think it does help to have a sort of overall investment philosophy.
And that value that you were speaking of, where are you finding value at the moment? Where's interesting?
Well, it's a good question across the market. I mean, in terms of our portfolio, we've got a core of kind of consumer staples companies within the fund, which are the companies like Diageo, Unilever, which have done very well in the long run. But I think certainly the oil sector, we've got big holdings in Shell and BP, which offer very attractive dividend yields. They're more kind of income plays, I would say. Of the domestic sectors, we actually think the banks look quite interesting. We particularly hold Lloyds and HSBC in our top 10, and we think the banks are in a much stronger position than they were at the obviously going back the financial crisis years. And then one domestic sector we quite like, where we've just got Taylor Wimpey just outside the top 10, is the house builders, where we think there are some very attractive yields on offer in the house builders. So we've got 3 house builders, of which Taylor Wimpey is the biggest.
That's interesting. So it sounds like you've got sort of both sides covered. You've got the UK blue chips with an international focus, but then you've also got companies that are really, I mean, Lloyds in particular, we talk about as a bellwether for the UK economy,
Yes.
and house builders as well.
Yes.
If the UK economy
Yes.
is doing well, they tend to do better.
Yes, I mean, I think there is a lot of potential in some of the UK domestic stocks. I mean, if you look at the top 10, Lloyds is the only really domestic stock, actually. The other 9, are kind of really global companies. They're UK listed companies, but they're kind of global. Even HSBC is, of course, much bigger in Asia Pacific than it is in the UK. The majority of its earnings come from Hong Kong and Asia Pacific. I think in terms of domestic economy, you have to be wary of some sectors, though, where disruption is really affecting them. And, for example, retailing is a very difficult area. High street, as we all know, high street retailing is with the growth of internet commerce, and it's taking sales away from the high street, whilst at the same time costs on the high street go up, business rates, wages, etc. So I think a lot of traditional retailers are caught in quite a nasty squeeze. So I think you have to be quite careful in your selection in terms of which domestic sectors you back at the moment.
And really nimble, I imagine, because with such a track record, there will be some companies that have been absolute beauties for you for some years, and then the business model changes or the sort of broader environment changes,
Yes.
and you have to see that moment.
Yes.
and take a call.
Yeah, I think you have to. I mean, I'm not a high turnover manager. I tend to invest for the long term. So, but when a share does really well in the portfolio, I would tend to take, and it gets re-rated, so it's on a higher kind of valuation than when you bought into it. But things are still going well for it. I would tend to sort of reduce it a bit and then recycle the money into other areas, but keep the sort of core holding, but take some of the profit, because you might regret it if you never quite know what's around the corner. But sometimes you buy a stock on a particular thesis, and actually you got it completely wrong, or it may not be completely wrong, but there are things that are factored in which you underestimated, and it turns out negatively, and then you do have to really cut your losses and just admit you got it wrong and move on. It's quite important to remember why you bought things in the first place, and that's a helpful discipline, I think, to rather than just getting trapped in something forever.
Yeah. So what's been a real win for you over the years, if you could think of one company that has performed strongly?
Yes. Well, I sort of mentioned it earlier in passing, but Diageo has been a very good share for me. I mean, going back a long time, 20 years or so ago, it was a conglomerate. It was originally formed through the merger of Grand Metropolitan and Guinness owned distillers, and it's basically the world's biggest alcoholic beverages company, particularly in spirits, not in beer, but it owns the Guinness beer brand. But going back, when I initially invested, it was something a conglomerate had some food interests in the United States, actually owned Burger King at one point as well, and it sort of divested those interests and focused on spirits and Guinness beer, and I sort of bought into it at that point, and I've added to it over the years, and it took a while to come off, and it's not been a straight line. It's also it's had its weaker periods, but essentially I think it's an extremely well positioned company. I mean, it's owns some of the iconic beverages brands like Johnny Walker whiskey. It's 40% of its profits come from the United States, but it also has very strong interests in emerging markets as well. And in recent years, they've benefited a lot from the boom in gin and tonics with Gordon's Gin is helpful for them. So, what I like about it has got assets. It hasn't got it has got physical assets in terms of whiskey stocks, but also it's intangible assets, it's brands. But they have to invest in those brands and innovate, otherwise they wither away. But it seems to be well managed, and it's grown to be the second biggest holding in the portfolio. And it's a very global company, and but it's a leading British company, and I think I think it is. I'm very pleased that it's done very well over time, but it's been a kind of slow burn. There've been periods when investors needed to be patient.
It's nice to be rewarded for that patience.
Yes.
And then conversely, I suppose on the other side, a company that you've bought on a particular thesis and it hasn't quite panned out as you imagined.
Well, when I moved out to Esher from London in 1997, when I first started taking training to Waterloo, everybody was reading newspapers or books, and now, in fact, I moved to Waterloo-on-Thames, and now on my train journey, everybody's looking at their mobile device and reading or playing games or listening to music or whatever. And you'd have thought this massive growth in mobile data, this would have been very good for mobile telephone companies, but Vodafone, which I've had in the portfolio, has been a really disappointing. It hasn't been a disaster, but it basically has gone nowhere over many years, and this year it cut its dividend by 40%. We actually reduced it at the end of last year, and so we've got a below average compared to the market exposure in it. And it still has got some good assets. I mean, there's no question about that. It's very big here in the UK, but also number 2 in Germany, behind Deutsche Telekom in terms of mobile, and also some cable networks. Got interests across Europe and outside Europe. So it's got some great assets, but they've just struggled to monetize this. We're using so much more mobile data, and yet they haven't really seen the benefit, which is very frustrating and disappointing from an investor's point of view.
That must be so frustrating. So you look around the pub and you see everyone drinking their gin and tonics, and you think happy days, and yes it is, and Diageo benefits. And then you look around your train at everyone using their mobile phones and think, well, where's the profit? Thank you very much.
Yes, no, it is. It's a very interesting juxtaposition, isn't it? That I suppose the people who've really benefited are, people like Apple who make the mobile phones. They've and it's their technology has been phenomenal. And I think in the UK there's been just so much competition. That in the UK we've got 4 or 5 mobile operators. So whilst actually in the United States, where we actually hold Verizon as one of our overseas listed stocks, and that's one of the 2 big US telecom stocks, the other being AT&T, and there are 2 challengers, so like 4 mobile telecoms companies and fixed line for the whole of the United States, and it's a much more ordered market, and the companies invest a lot for good service as well, and so we've actually got more in Verizon than we got in either Vodafone or BT, and Verizon's grown its dividend consistently every year for the last 5 years by 2%, and has carried on reducing its debt. So it's a sort of big contrast, and
Vodafone.
To the operators like Vodafone over here.
Joe, thank you so much for talking us through the trust, and thank you for joining us.